The real breakthrough will come when the industry, or enough of the industry to be substantial, begins to affect blockchain-style transactions in commodities, when commodities, probably starting with gold, become tokenized, and the token represents redeemable physical commodities held in various places. My suspicion is...
Welcome to a visionary discussion with Rick Rule. In this video, we delve into the potential game changers in the world of commodities and blockchain technology. Rick Rule shares his insights on the groundbreaking moment when the commodities industry began embracing blockchain-style transactions, starting with the tokenization of assets like gold. He believes that the future of many commodities might be in standardized, tokenized distribution, possibly within the next 5 to 10 years. Stay tuned to explore this fascinating glimpse into the future of commodities and how technology is set to reshape the industry.
I don't know that there are any screens as to longevity or solvency. One thing that you can do to screen is screen for positive working capital. This is a capital-intensive business. The juniors are almost all, by definition, pre-revenue. And the first test of stability is solvency. Screening for free working capital on a tool like Bloomberg or Yahoo is probably the first step. But the second step needs to be done manually. You need to look at least the last 2 years' annual reports and figure out what the company's burn was over 2 years. If a company, as an example, has $5 million in the treasury, and that seems adequate to you, but you find that they've been spending $7 million a year for the last 2 or 3 years, what you come to the conclusion that you come to, is that they only have 8 months worth of working capital left, and you need to become concerned. There is no one-size-fits-all rule of thumb, sadly. My own experience is in a natural resource bull market, which we are not in yet, that the biggest companies in the sector can give you doubles or triples. Pretty good return relative to the risk. In addition, because none of us know when that blessed moment, the bull market, is going to come, the dividend streams from the very largest companies reduce the risk that you run with regards to the time value of money. I suggest to people that they invest before they speculate, with the careful note, Dunnigan, that I speculated before I invested. All of the money that I now carefully invest, I made through wild speculation. If one is willing to do almost any work at all, there's no particular need to own an oil and gas ETF, given how many very high-quality names there are for the individual investors to buy outside of the ETF wrapper. I do, personally, buy ETFs to balance my portfolio in sectors I don't understand. As an example, I personally own the Dividend Aristocrat, which is an ETF on very, very, very large U.S. companies that dominate the sectors that they're in and have met or exceeded dividend forecasts every quarter for 30 years. I don't have enough background in various industries to understand companies like Merck or Shearing Plow or Procter & Gamble. And while I know that owning the biggest and finest companies in the United States is something that I want to do in my portfolio for the long term, it isn't worth my while to research those companies. The consequence of that is, where I have less knowledge, I do employ an ETF. The answer to that is absolutely. The market is innovating constantly, and the increasing access that various players have, as an example, to banking, but the increasing access that various players have to each other as well, means that the old inefficient mechanisms like the LBMA are being forced to innovate, even as competitors are looking to disrupt them. The second thing that you're seeing is that the old market mechanisms are inefficient mechanisms for new actors that don't have exposure to them. And what is happening increasingly is that there are off-market transactions, often on a negotiated basis. As an example, the difference between the term market in uranium and the spot market in uranium. The real breakthrough will come when the industry, or enough of the industry to be substantial, begins to affect blockchain-style transactions in commodities, when commodities, probably starting with gold, become tokenized, and the token represents redeemable physical commodities held in various places. My suspicion is that the technology that enables that exists today, but the mechanism for a broad trusted market that's tokenized probably doesn't come about for another 5 years. But I suspect that the future of many commodities will be in standardized, tokenized distribution 5 years or 10 years hence. The other broad disruptor will, of course, be directly negotiated transactions of the type that were popularized in the 60s by the Japanese trading companies that didn't have access to the resources where they'd been frozen out by American or European actors. Zimbabwe, worse, although improving a bit, unlike South Africa, and Russia. The current weakness that you're seeing in platinum, I suggest, is mostly a function right now of Russian dishoarding. The Russians, as you might have gathered, have a need for cash right now. And the consequence of that is that all kinds of commodities, from potash to platinum, to oil and gas, to copper, to nickel, to diamonds, are being sold quietly but wholesale by the Russians to raise cash for their obvious needs. If the conflict in Ukraine begins to blow over, my suspicion is that when markets normalize, Russian inventories won't be there to service the market. The other reason to own platinum, of course, as a speculator, is that if there is a supply disruption as a consequence, as an example of internal political discord in any of South Africa, Zimbabwe, or Russia, there would be extraordinary falls in platinum production, and likely as a consequence of that, soaring prices. It's worthy to note, and I'm sorry to spend so much time on this answer, but it interests me. It's worthy to note that platinum has a lot of upside simply because in the fabrication technologies for which it is appropriate, the price of platinum is almost irrelevant to the finished price of a product. It costs $125 to produce enough platinum to make a catalytic converter in a Mercedes or some sort of car like that. The idea that if you double the price of platinum, so the price of a catalytic converter, the platinum in a catalytic converter, goes from $125 to $250, it has absolutely no outcome on the price or the cost of the car which is produced. A $50,000 car wouldn't go up very much at all if the price of platinum doubled. If you have a supply shortfall where the price has to go up and the price can go up because of elasticity in price, it will go up. The applicability of an asset class in any portfolio is mostly a function of that portfolio. What is it that the investor is trying to accomplish? Is the investor a speculator? How much risk can the investor handle? What period of time is the investor looking at? I would suggest that the most timely speculation in the natural resource field is certainly uranium, one where the bull market that we have anticipated for 2 years or 3 years is really and truly underway. Having said that, the uranium juniors have all doubled. So it's likely that the easy money has already been made. The easy money has been made when a sector is hated, and uranium is no longer hated. For most investors who are looking for stability in an industry, income, and price escalation over time, I would suspect that the best natural resource industry for most investors, not speculators, but investors, is the oil and gas industry. It's difficult to find a company with better market prospects and better balance sheet, better asset allocation than ExxonMobil. So for many investors, although it's really, really, really boring, and although President Biden and Prime Minister Trudeau and my favorite energy physicist, Greta Thunberg, all those folks don't like it, for most investors, that's probably where you start your natural resource portfolio.
As we wrap up this enlightening discussion with Rick Rule, we've gained valuable insights into the future of commodities and the potential impact of blockchain technology. The vision of tokenized commodities and the evolution of trusted markets is on the horizon. We hope you found this video thought-provoking and informative. If you enjoyed this discussion and want to stay updated on the latest developments in the world of commodities and technology, please like this video and subscribe to our channel. Your support is greatly appreciated. Thank you for joining us today, and we look forward to bringing you more cutting-edge insights in future videos. Until then, stay curious and stay informed. See you in the next one.